$550K salary beats $480K unless you model the equity. Here's the $2M math most engineers miss. You got the promotion, bigger title, smaller paycheck. L6 staff engineer at Google starts at $550,000 base. The principal engineer role $480,000. The gap looks obvious, $70,000 a year in your favor, $700,000 over a decade. But here's where most tech workers make the mistake. They stop reading the offer after the base salary line. By the end of this video, you'll understand exactly when the principal equity track overtakes the staff base salary, and why the RSU vesting cliff in years 4 through 5 changes the entire equation. If you're aged 35 to 45 and this decision is in front of you, the math could mean $1.5 to $2 million in your net worth over the rest of your career. Let's start with what the offer letters actually show. L6 staff, $550K base, $300K to $450K equity package refreshed annually, bonus 20% to 30% of base. Principal $480K base, but a significantly larger equity allocation, often $600K to $800K in year 1, with accelerated refresh grants tied to performance milestones. The base salary difference is real, but equity isn't salary. Here's the critical piece. Google's RSU vesting schedule is 4 years with a cliff at year 1. If you join principal with an $800K equity package, year 1 cliff vests $200K, but year 2 through 4 add another $150K per year. Now layer in refreshes, research from levels. FYI and Glassdoor data shows principal track engineers at major tech firms receive equity refreshes averaging 15% annual appreciation compounded with new grant cycles starting in year 2. Staff roles typically refresh at lower clip, closer to 8% to 12% to maintain the base salary-heavy structure. Let's model 10 years. Year 1, staff $550K base plus $112K equity value equals $662K total comp. Principal $480K base plus $200K cliff plus $150K appreciation on refresh grants equals $830K total comp. Principal ahead by $168K. But you're thinking, the base salary gap will make up ground. It won't. By year 4, the equity refresh cycle and compounding gains push principal to roughly $920K to $950K in total comp. Staff stays at $660K to $680K base driven. That's the year the gap flips permanently. Principal is now ahead $240K to $270K annually. Year 10 is where it gets stark. Assuming historical Google stock CAGR of 15%, which matches the 10-year performance data from SEC filings and Yahoo Finance, the cumulative principal equity package reaches $1 to $4 million in realized and unvested value. Staff total compensation over the same decade, roughly $6, $8 to $7, $1 million in base salary and modest equity gains. Principal over the same span, $7, $8 to $8. $2 million when you account for equity appreciation, refresh cycles, and the compounding effect of larger initial grants. The delta, principal comes out $1 to $5 million ahead by year 10. Some models accounting for higher promotion velocity on principal track, which can unlock senior principal or distinguished engineer faster, and equity refresh bonuses tied to peer performance, push that to $2 million. But here's the real trap, taxes. Staff base salary is ordinary income taxed at 37% federal for high earners. RSUs vest as ordinary income too, but at grant value, not future appreciation. Principal's larger equity package means more of your comp is locked in lower basis grants, and you can time capital gains realization across decades. One senior engineer we analyzed at a major tech firm structured a principal track promotion specifically because it allowed her to defer $300K in annual equity appreciation into lower tax rate years near semi-retirement. That alone saved her $90K in taxes over 8 years. Now the real question, does your principal offer include equity refresh language? Does it lock in annual grants or does it depend on performance reviews? This matters enormously. Principal role with guaranteed annual $150K refreshes beats a staff role with discretionary refreshes every time. But a principal role with performance-dependent equity that dips in down years, you need to model the downside. The decision isn't about which title sounds better. It's about modeling the vesting calendar, refresh language, and your company's historical equity performance. Most engineers skip this because equity feels abstract next to a salary number. But over 10 to 20 years, it's the difference between retiring at 55 and retiring at 65. Your career is the largest asset you own.